Ticker symbol HWM is up over 80% in the past year, and today we'll be looking at a solid growth stock with an incredibly wide moat, which is a great play on defense and travel. Its net income is up over 51% in the past year, and its net margin has almost doubled from June 2023 all the way up to now, so in 1 year and a half. Today we'll be looking at none other than Howmet Aerospace, an aerospace, defense, and mobility company. In their annual report, they state that they're the leading global provider of advanced engineering solutions for the aerospace and transportation industries. Basically, it produces products used in the commercial and defense aerospace sector, which represents 54% of the revenues. Then they also focus on products for commercial transportation, such as trucks and vans, which represents 21% of their total revenues. And then they have other markets, which are also related to transportation, and these account for 15% of their revenues. They break all of their product portfolio into 4 different segments, which is how they recognize their revenues, with the first one and the largest one being engine products, which represents half of their total revenues. Here they basically produce components for different aircraft engines and for industrial gas turbines. Here they include airfoils, seamless rolled rings, and other more specific components. Howmet does not produce the engine themselves. That is probably something that is done by either Lockheed Martin, by Boeing, Airbus, and these other companies, but Howmet's products are essential in producing these large engines. Then 20% of their revenues is basically accounted for by their fastening systems, which are used by the aerospace, their industrial, and the commercial transportation sectors, which are these systems or these bolts that are used in order to stick parts together. Then they have engineered structures, which represent 18% of their total revenues. And over here they work with different raw materials, as they produce titanium ingots, forgings, and even forming machine services for airframe, wing, and landing gear components. And last but not least, then they focus on the airframe structural components, which account for the last 13% of their revenues, where they produce aluminum or aluminum if you're American, wheels for trucks, buses, trailers, and even other products for the transportation market. So despite engine components being the clear leader for this company's revenues, you can see that they're fairly diversified into other components. But when we look at their financial analysis, this company is actually doing very good, as they have a return on capital employed which is above 17%. Now we usually look for a threshold which is anything over 15% is considered a company which has a very good return on capital employed, because it means that they're able to generate value for their investors. Then they have a 9 times interest coverage ratio, which we usually like to find above 10 times. They have a 75% cash conversion rate, a 31% gross margin, and a 16% net margin, again above our threshold of 15%. And this company had been having a very nice predictable revenue growth. However, it looks like in the past couple of quarters it has accelerated. And same has happened with their net margin, where since June 2023, where their net margin was just above 8%, it has risen consistently every single quarter, and it's now sitting at 16%. If this can go on, of course, this company will be a long-term winner for sure. And this, I believe, is the expectation, as the market has priced an 80% increase in the stock price in the past year, as we saw at the start. And as we always say, their efficiency ratios usually follow net income, which is why we can see all have been rising consistently every single quarter and accelerating after June 2023, with return on invested capital being right over 20%, which is the ratio we like to focus from this slide. And when we look at their balance sheet, there is something very interesting which we don't see very often. Well, first of all, we can see that their assets are way above their total liabilities, which gives them a very solid current ratio and makes this company more attractive for more conservative investors. However, we can see that both their total assets and their total liabilities have been decreasing year after year after year. I do have to say that this is not a bad thing. It basically means that if they were generating the same amount of net income in 2015 than they are now it looks like their efficiency ratios are a lot better, because they're able to generate the same amount of income from a lower base of total assets, meaning that they're better at managing the assets that they have. And when we look at their fundamental analysis, I'm happy to say that this company gets a solid 7 out of 8 ticks, almost the perfect score, as they have low liability risk. I know they have a 9 times interest coverage ratio instead of a 10 times that we usually look for, but being so close and being so consistent with their net income, this shouldn't be a problem for them. Then They have a very solid balance sheet as we have seen, but the fact is that they're able to pay out all of their short-term liabilities only by using their current assets. Next, as we will see, they're able to pay very consistent dividends which have been growing over time, and they use any of the remaining free cash flow that they have generated to use in share buyback programs and return a lot more value to investors. Now, they're also able to grow their free cash flow organically, which is mainly being funneled by 1, that organic revenue growth, and 2, that net margin expansion that we have seen. And important to consider that by organic, we basically mean that they're able to grow all of this without relying on acquisitions. And now, the 2 factors that are most important in this slide, pricing power and existing moat or competitive advantage, I'm sure that Howmet meets them both. Pricing power we usually define as being able to increase your prices at a rate which is above inflation for a long time without losing customers. And in the case of Howmet, I believe that their pricing power comes from the same place where their existing moat actually comes from, which is the fact that this industry has extremely high barriers to entry, as you need an incredible knowledge of all the technicals that go into developing engine components and all different airframe structure and fastening systems that they construct, but you also need a large amount of cash in order to gain agreements with different manufacturers or even produce these components in-house. When it comes to anything related to aerospace, we know that all these costs to produce airplanes is extremely high, but we also know that in this sector, it is a lot more important to focus on the quality of the components or of the parts that you're buying than on the price of them, because safety, reliability, and durability are the most important factors when looking for suppliers in this field. And the fact is that all the components produced by Howmet are some of the best when it comes to these aspects in the aerospace sector. This allows them to be classified as best in class in their industry, and when any of these large clients, whether it is Airbus, Boeing, Lockheed Martin, which are producing these airplanes and sourcing for these parts, well, they will be happy to pay a lot more for Howmet's parts because they know that they will be reliable, of good quality, and be able to make their end product, the airplanes, a lot better. This, first of all, gives Howmet the ability to increase their prices year after year at a rate above inflation without any of their clients actually being able to source these parts elsewhere, because there is not a wide base of suppliers in the world, but is additionally the source of their existing moat, where first of all, there are not many competitors in this field, second of all, it is extremely hard for new competitors to emerge out of thin air in this industry, but third of all of their existing partnerships with these large clients are already in place, so they have already developed some sort of brand loyalty or brand recognition, which is essential in letting everyone else know that they're the supplier with the highest quality products. However, there is one thing that I didn't like from their fundamental analysis, which is the consistency of their free cash flows. Although their free cash flow is growing, it is very hard to predict how much free cash flow they would generate in the following quarters. Now, when we look at their dividends, we can see that this company was hit hard in the COVID pandemic, as their dividends went to an all-time low in August 5th, 2021. However, since then, they have been increasing at a very fast pace, and currently it has a 0.23% dividend yield. Currently, they only have an 11% payout ratio, which means that they have a lot of room in order to increase their dividend payments before they start feeling uncomfortable or slowing down the growth for these dividends. And when we look at their valuation analysis, it does seem like this company is currently trading at some of the highest multiples it has been trading for the past 4 years, currently closing in on a 48 times price to earnings multiple, which, when we also add in the fact that their 1.83% free cash flow yield is way below the long-term inflation rate, these two metrics suggest that this company may be trading at a very overvalued valuation. And when we look at the risks and possible challenges, I see two main challenges. The first one being possible upcoming regulation changes. Since these companies' revenues are very linked to, first of all, commercial aerospace, but second of all, defense, these two sectors are very much dependent on government regulations. Commercial airplanes, because there are a lot of regulations on the quality of the parts, but the second sector, more importantly, is very dependent on the budget that the US actually decides to funnel into their defense spending, which honestly it looks like it should increase, but it's a risk as it's very uncertain and and their revenues are very dependent on this factor. And the second risk that I see is the cyclicality risk, where in terms of their largest sector, which is the commercial aerospace, This is very dependent on whether the economy is booming, in which case these clients will spend a lot more on ordering airplanes, which will result in a higher income for Howmet Aerospace as they will have a lot more work to do in developing components. However, when there is an economic downturn, there is generally a slowdown in the purchasing of airplanes, which generally leads to a lower volume and lower income for companies like Howmet. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a strong competitive advantage. It is generating, although not consistent, growing cash flows and has high return on capital employed. So I believe that this is a good company and it may be a good investment. However, right now it's trading at high multiples. Having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content and I'll see you in the next one.